Good morning, everyone. As I'm sure you're aware, today is our last class together. It's been a good semester, and I wish you all good luck in the future, good health. Um, you know that we are going to be having our final on this coming Tuesday. It's going to be on McGraw-Hill, and it's going to be from 11 a.m. through 1 p.m. Okay, so you'll have 2 hours for approximately 50 multiple choice questions. And then I'll be posting the final grades on Blackboard, and then you'll hear shortly after that, from the registrar what your final grade for the semester is. So what I wanted to do at this point is, first of all, take any questions if you have any, and if not, I just want to go through. I put together a summary really of the key areas that we've studied this semester, and also the areas where excuse me, your attention should be focused for the exam. Okay, so we'll go through it on a chapter by chapter basis. Sorry, when are we going to have the results? The results, for the final, the results for the final exam I have to wait to post the exams until the other class takes it. So the grades for the final exam will be available on the 17th or 18th, which is Thursday or Friday of next week. Okay, you could have your scores, but I can't let you see the questions before then, so I'll set it up that way. Okay, so I'll try to make it so that you have your scores after the exam, but you won't be able to see exactly which questions you got right or wrong. Okay, because I have another section taking this class as well, taking the test at a later time. Okay, and I think I have to submit my grades, I'm not sure, I think by the 18th or 19th of December. So the final grade you'll be hearing shortly after that, I would assume. Okay. All right, so for chapter 12, okay, now going back all the way to the beginning of the semester, remember when we were talking about the income statement, we went back and revisited the income statement. Something that we studied was the earnings per share. Okay, remember, earnings per share is a very important figure. It must appear on the annual financial statements, okay, that are prepared and audited by the outside accountants. In its most simplest form, okay, earnings per share is going to be computed by taking the net income, okay, the total net income, if it's a simple structure with just common stock outstanding. We're going to take the net income for this year, okay, and divide by the weighted average number of common shares outstanding. Okay, so now remember that when you're doing the earnings per share, it only signifies for the common shares. Okay, a earnings per share figure is not calculated for preferred stock. Okay, so in its most simplest form, this is what the formula is going to look like. Remember though, if the number of shares changes, if the number of common shares outstanding changes over the year, that is, if the corporation issues additional shares of common stock, or if they buy back shares of their own stock as treasury stock, you're going to have to do the weighted average, okay, which basically divides by, you're going to look at the amount of time that the number of shares were actually outstanding for that year and get a weighted average of that. Okay. Now, if the form of corporation is a little bit more complex, okay, and they have preferred shares outstanding as well, okay, that is going to affect the earnings per share calculation. In that instance, if there is preferred cumulative stock, okay, again, preferred cumulative stock, what you're going to do is take the net income, okay, and then in the numerator, and then from the net income, subtract the preferred cumulative stock dividend, okay, from the net income. But again, even if the dividend is in arrears for several years on that cumulative stock, you're only going to subtract the current year's dividend from that preferred from the net income. Okay, only the current year's cumulative preferred dividend. Okay. Then once you subtract that, then you're going to divide again by the weighted average number of shares. Okay. Now, what can also happen in the instance that this corporation has convertible securities outstanding? Okay, and again, convertible securities, basically in the description of those securities, it indicates that at the discretion of the holder can decide to convert their convertible security into shares of common stock of the corporation. Okay, and those convertible securities could be stock options, they could be preferred stock, they could be bonds payable. Okay, and then the last one that we're talking about, this last earnings per share figure here, is when you have convertible securities outstanding. Okay, and this is called the fully diluted earnings per share. So if a corporation has convertible stock, in addition to the regular earnings per share that they're showing here, okay, that is one of the two above formulas, they're also going to have to show diluted earnings per share. This is an additional calculation that they have to do, okay, and it's going to show what, again, you're going to start with the net income in the numerator, okay, but then when in the denominator, you're going to add the number of common shares outstanding, okay, and that could be a weighted average as well. And then to that amount, you're going to add the convertible securities outstanding as well. The number of convertible securities that could have been traded in for shares of common stock. So the last one, the last earnings per share figure is really like an as if, okay, a pro forma calculation. If all those convertible securities did get exchanged for common shares, what would the earnings per share in that situation be? Okay. Can you see? Well, you could go. I don't want to get too involved because you could go back to the book and just take a look. Because we went over this all through the semester. Here for this instance, it would just be the net income, and then here, let's say I'll do the last part, the convertible securities. So let's say in this instance, this company had 10,000 convertible bonds. Okay. And again, in the description, it says that they have 10,000 convertible bonds outstanding. Okay. And then at year end, okay, when this diluted earnings per share calculation is going to be undertaken, if they have 10,000 convertible securities and they're exchangeable on a one-to-one basis. So that is for every convertible bond they have, those holders can convert those bonds on a one-to-one basis, okay, for a share of common stock. What you would do in the third scenario here is when you would take the number of common shares outstanding, and then you would just add to that figure the number of shares of common stock that could have been available. Okay, to those convertible bondholders. Okay, so you would increase the number of shares outstanding by the number of convertible securities. Okay, you're welcome. And again, it's whatever the ratio is. If I told you those bonds were convertible into common shares of stock on a 2-to-1 basis. Okay, again, if it's a 2-to-1 basis, let me just erase this. If the way that they're able to convert those bonds is on a 2-to-1 basis, if there were 10,000 bonds outstanding, okay, what would you do? You would just add 20,000 shares of common stock to that formula, okay, in whatever the ratio is that they're able to convert. Okay. Okay, so let's continue from there. The next thing that we discussed in chapter 12 was the prior period adjustments. Okay, now who remembers, all right? How does a prior period adjustment come about? Okay, what has to happen for a prior period adjustment to basically exist? Anybody remember? Okay, I hope you've all started studying already. All right, for a prior period adjustment to come into existence, what basically happened? Yes, we're going to adjust. Very good, Joshua. We're going to adjust the retained earnings, okay? And why? Because for a prior period adjustment to take place, there must have been an error which occurred in a prior period. Okay, and now this error occurred and it affected the net income of a prior period. Okay, so let's say they forgot to depreciate an office building for some reason. They forgot to fully depreciate an office building in a prior period. Okay, that error just came to light in this year. Okay, but since the corporation did not deduct that depreciation expense in the previous year, what does that mean? That means that the retained earnings are overstated, right? The retained earnings are too high because the expenses were understated in the previous year. Okay, so again, a prior period adjustment, the error occurred in the previous period. Okay, but you can't go back and restate all the financial statements for those previous periods. So what are you going to do? You're going to make an adjustment in the current year's statement of retained earnings. Okay, in the current year statement of retained earnings, you're going to adjust what the opening balance is. Okay, so you'll have the opening balance, which for retained earnings, which of course was the closing balance as of the end of last year. Okay, and then you're going to add or subtract whatever that prior period adjustment is from this year's retained earnings, and then you'll just continue normally as you regularly do. Okay, add the income for the net income for this year, subtract any dividends, and that gives you the ending retained earnings for this year. Okay, so remember that, how to treat a prior period adjustment. Okay, now remember we looked at, we revisited the income statement as well. Okay, and remember now when a corporation basically disposes of a segment of a business. Okay, so here, when we have something that is called discontinued operations, that means that there was a disposal of a segment of the business. Okay, so that would be like when American Airlines disposes of their helicopter division. Okay, not when American Airlines just sells off some of their helicopters. Okay, it's a disposal of an entire segment of the business. Okay, now when that happens, all right, the way that the income statement has to be set up is going to be different. Okay, what's going to happen that in the new income statement, okay, when there's a disposal of a segment of the business, what appears at the top, okay, is you're going to have a section called income from continuing operations. Okay, so you're going to start with your regular revenue figure. Okay, then you're going to have, let's say you have your sales revenue, your interest revenue, all of your regular revenue that you anticipate that you've had previously, most likely. Then remember the last line, okay, the last line in the income from continuing operations is going to be if there are any unusual and infrequent items. Okay, so remember, any unusual and infrequent item is going to be a separate line item. Okay, it's going to be required to be reported as a separate line in the continuing operations section. Okay, and it's usually going to be the last line, whether it's an increase or a decrease in continuing operations. Then you would have a subtotal for the continuing operations. Then you're going to have the next section is going to be itemized as discontinued operations. Okay, and in the discontinued operations section, two pieces of information must be shown. The first thing you're going to show is either a gain or a loss on the operations year to date. So you're going to have a figure, okay, that shows what the gain or loss from operating that segment that was disposed, okay, what the year-to-date gain or loss was. And remember, typically you're going to be given this information. Okay, you just have to know how to basically format the information. Okay, and remember, when you're dealing with discontinued operations, it's always going to be net of the tax effect. Okay, so that's the first piece of information for discontinued operations. The second piece of information is whether there was a gain or loss on the disposal of the assets of that division. Okay, a gain or loss from the disposal of the assets of that division, separate line item under discontinued operations, and it's also going to be shown net of the tax effect. Okay, and now you have these two discrete sections on your income statement when you have a disposal of a segment. And then after those two sections, what are you going to show? Then you're going to show the net income. Okay, the final net income, combining those two segments, the continuing operations and the discontinued operations. And again, if you are an investor, okay, or if you're a creditor, which section are you more interested in? Okay, are you more interested in income from continuing operations? Very good, Joshua. You're more interested, and that's why it's separated this way. Because if you're interested in what the future operations of this corporation can be, okay, you're more interested in the top part. Okay, because this disposal from discontinued operations is really not going to affect future income or future operations of this company. Okay, so that's why it's divided this way. Also remember that earnings per share has to be disclosed for continuing operations, as well as from the net income, the bottom line net income also. So you're going to have a total earnings per share that appears here. All right, and you're also going to have an earnings per share figure that appears here for the continuing operations as well. Okay, good. Okay, the next chapter then was the liabilities. Okay, and liabilities specifically, what we dealt with in that chapter was bonds payable. Okay, now remember, bonds payable is debt that is issued by the corporation, okay, which is going to be outstanding for a significant period of time. Typically, it's going to be approximately 20 to 30 years. Okay, so it's a long-term debt. All right, and we looked at the first thing we looked at were the different prices that the bonds could be sold at. Okay, so if bonds are sold at their face value, okay, that means they're sold at 100, okay, or at 100%. Okay, so the amount of cash that they receive, okay, remember when bonds are sold, okay, the journal entry is always, regardless of their price, it's always going to be a debit to cash, okay, on the books and records of the corporation, and a credit to bonds payable. Okay, that's always the first journal entry on the date of issuance of those bonds. Okay, and if bonds are sold at 100, you know that those two amounts equal at the face value. Okay, remember the amount that is credited, okay, very important hint, the amount that is credited into the bond payable, okay, is always going to equal the maturity value. Okay, the value of the maturity value of those bonds when they have to be paid back to the investor. Okay, now the second price that bonds can be issued at is they can be sold with accrued interest. Okay, when does this happen? Bonds are sold with accrued interest, okay, when they're sold between interest payment dates. Okay, so here, if there is accrued interest on the bond, all right, what the journal entry, what does that mean? That means that for that particular bond issue, when I sell them to you, the investing public, you are going to give me more, okay, than the face value of those bonds. Okay, and why? Because of the fact that I'm making you prepay to me, okay, for that portion of interest that is due for the time period since the last interest payment date. Okay, so what's the journal entry that you're going to record whenever bonds are sold between interest dates? Remember, the amount of cash the corporation receives is greater than the face value. So you're going to always have a debit to cash, okay? Then you're going to have a credit. Remember, whenever bonds are issued, you're always going to have a credit to the bonds payable, okay? But remember, in addition, you're giving me excess cash. You, the bondholders, are giving me excess cash because you're prepaying a little bit of that premium that I'm going to give back to you. So here, there's going to be an additional credit of bond interest payable in this circumstance. Okay. All right, and that would be the journal entry. All right. Now, the third price that a bond could be sold at is if these bonds are sold at a premium. Okay, and immediately, if you're told that the bonds are sold above 100 or above 100%, oh, I'm sorry, Francisco, because on Blackboard, sure. So just remind me at the end of class, or just send me an email if I don't do it after this class. You're welcome. So here, if bonds are sold at a premium, okay, that means they're sold, for an example, at 101, 102, maybe 103, but it's over 100%. Okay, so the amount of cash that's being received is greater again than the face value, but it's different from when if bonds are sold above. I'm sorry, bonds are sold between interest dates, right? So the first question you always ask yourself when you have a bond problem is which one of these four scenarios are we dealing with? Okay, if bonds are sold at a premium, okay, the journal entry on the date of the sale, remember the corporation is always receiving cash and you are recording this journal entry from the corporate perspective. You're going to debit the cash account, and you know you have to credit the bonds payable. Okay, you're going to credit the bonds payable for the maturity value of the bonds. Okay, but in this instance, remember, you're giving me, again, the bondholders are giving me more cash, okay, above the face value of the bonds. All right, so what is going to be the additional journal entry? The additional journal entry is going to be on premium on bonds payable. Okay, premium on bonds payable is going to be the additional credit on the date of sale of those bonds. Okay, and remember, when bonds are sold at a premium or at a discount, this premium or discount is going to be amortized over the life of the bond. Okay. And again, when it's sold at a premium, more cash is received than the face value of those bonds. Okay, and then another price that bonds can be issued at is at a discount. Okay, so now if you're given a problem and you're told that the bonds are sold at 99, 98, any amount that's less than 100, that means they were sold at a discount. Okay, now when bonds are sold at a discount, it basically increases the effective interest rate. Okay, it increases the effective interest rate to the corporation. Okay, because they're receiving less cash from you up front. But remember, it doesn't matter how much cash the corporation receives up front. I'm always going to have to pay you back the full maturity value, the face value of those bonds. That's the legal obligation for those bonds. Okay, so here when bonds are sold at a discount, on the date of issuance, yes, the corporation is receiving cash, so they're debiting cash. They're also crediting bonds payable. Okay, but since, and again, that's for the maturity value. Again, since though the corporation is receiving less cash, okay, what they're going to also debit is discount on bonds payable. Okay, and that's going to be a debit entry on this day. And remember, discounts on bonds payable, they basically raise the effective interest rate. Okay, and that discount has to be amortized over the useful or over the legal life of that bond, whatever it may be. Okay, remember amortization here, amortization of a discount or premium is over the life of the bond. Okay, and also I would be familiar with the different kinds of bonds that may be sold by a corporation, either a debenture bond, okay, which is sold based on the general credit rating of a corporation. A convertible bond, which we talked about a little earlier, it has that convertible privilege to be converted into common shares of stock. Mortgage bonds, okay, which are typically given if the financial standing of that corporation may not be as strong as the creditor wants. So a mortgage bond, again, basically has a lien against particular assets of that company. Or junk bonds, okay, 4 different types of bonds that exist that a corporation can issue. The next chapter we went over was chapter 7. And chapter 7, remember, dealt with this. This is the first time you've basically dealt with a circumstance where assets of a corporation can be increased above the cost of the asset, but it could also be decreased below the original cost of the asset as well. So remember, this particular situation with available for sale marketable securities, they are so highly liquid. Okay, these securities are so highly liquid that they're almost cash. Okay, because all I have to do is call the broker. Okay, to basically, there's an active market for these securities. Again, they could be stocks, they could be bonds, etc. But they're so highly liquid that what has to happen is that at year end, basically the value of those securities is going to be adjusted to the market price. Okay, at that particular point in time, because it's almost as if it's cash. Those security holdings are cash. Okay, again, so available for sale of marketable securities are highly liquid. They are intended, when those securities are purchased, the intent is to hold them for the short term, for a short period of time. Okay, now, there's no long-term commitment to the company you're buying the securities in, and your plan is not, the corporation's plan is not to hold on to these securities until maturity. Okay, what happens at each year end is that the market value of these securities is going to, the value of these securities is going to be adjusted to the market value. Okay, so again, the asset account is going to be adjusted, the marketable securities asset account, and the shareholder equity accounts, okay, is going to be affected also. Okay, so remember, and again, these type of adjustments to the market value, they're not realized gains or losses, right? Because if it were a realized gain or loss, it would appear on the income statement. These type of gains or losses on the marketable securities are considered recognized gains. Recognized is that they're going to be recorded on the books and records, but they're not realized because they don't hit the income statement. Okay, and again, the adjustment to the shareholder equity account will be unrealized gain or loss. The adjustment would be, let me just type it in because it's easier for you to see. Unrealized gain or loss on marketable securities. Okay, just how we deal with that. All right, so that was chapter 7. Chapter 9 dealt with intangible assets. Okay, and some of the intangible assets that we talked about were patents, copyrights, franchises, goodwill, which was the trickiest one, goodwill, research and development, and trademarks. Okay, remember, these intangible assets don't have any physical form. That's why they're intangible. But typically, these things are some type of legally protected right, okay, which gives advantages or gives benefits to the corporation. Okay, now the trickiest one was goodwill. Okay, because remember, goodwill can't be internally generated. Just because this company has a history of sales higher than their competitors does not mean that in fact can basically have a goodwill account appearing on their financial statements. Goodwill is only going to be generated when basically the corporation buys out another business. Okay, when they buy out another company, and when in the purchase of that other company, they pay above the fair market value of the net assets. Okay, if they pay above the fair market value of the net assets, that's when you're then going to see goodwill, okay, being generated. Okay, remember that goodwill is typically, it's going to be tested. Okay, again, goodwill is the exception to the intangible assets. Remember that goodwill has to be tested annually, okay, to see if it has basically decreased. Okay, if the value of the goodwill has basically decreased. Okay, and then if you see that, let's say the level of sales is not what you anticipated it would be based on the level of sales from the business as it was basically conducting its operations previously, that's when you would basically recognize a loss on your goodwill because of the decrease in the sales. Okay, so remember, all of the other intangible assets are going to be amortized, typically over the shorter of their legal life or their their useful life. Okay, goodwill, however, must be tested annually. Okay. All right, the legal life of an intangible asset is typically the amount of time that the corporation gets that protective right. Okay, but there's many times that a legal life is different from the useful life. Because if basically you have a patent or copyright and basically there's a superior type of product which has been introduced by a competitor, you know that your copyright or your trademark really is ineffective now. So you would just write it off to expense at that time. Okay, and how you would go about doing that. Then the end of the chapter dealt with natural resources. Okay, remember, natural resources basically dealt with if the corporation buys some type of natural resource like a mine or a forest, okay, and they're basically going to deplete some type of resource from that property. Okay, how you deal with the record keeping for this type of asset. Okay, remember, when you have a natural resource, the first thing you have to do is you're going to have to figure out what the rate of depletion is. Okay, and the way you figure out the rate of depletion, you're going to take the cost of the asset and you subtract the salvage value. Okay, that, remember, also for natural resources, typically they're going to have significant salvage value. So you always have to subtract that in the numerator. And then you're going to divide by whatever the estimated capacity is. And you're going to be told that. Okay, what's the estimated maximum amount of whatever the asset this particular resource has? What is the maximum capacity that can be depleted? Okay, and this formula is going to give you the rate of depletion. Okay, whether you're depleting lumber or gold or any type of mineral from a mine. Then what happens? You get the depletion rate. Okay, and that's going to be per ton or per ton or per gallon, whatever, depending on the resource that you have. And then you're going to, in order to figure out the depletion, you're going to take the depletion rate and then you're going to multiply it by the amount that was extracted. Okay, so the depletion rate times the amount extracted okay, is going to give you the amount. Okay, the way you're going to record it, you're going to credit the journal entry when you extract that resource is going to be, and this is the debit one. Oh, here, I'm sorry. Here I have the formula. Whatever the depletion rate is times the amount of output. Okay, whatever that output is, that is going to equal the inventory that you were able to extract. So once you figure out the amount of depletion that you have and what the cost is that's related to it, you are then going to debit your inventory account. Okay, and the credit. Okay, and this journal entry is a little different when you deal with natural resources. You're going to then credit the accumulated depletion account. Okay, remember whenever we had depreciation, we would always be debiting depreciation expense, crediting accumulated depreciation. Here with a natural resource, what happens is that as we extract that resource from its natural environment, it is going to turn into inventory for this company. Okay, so you debit an inventory account, very different, and credit the accumulated depletion. Okay, so what happens when you deplete an asset from its natural resource? You're going to be decreasing the long-term asset, okay, and you're increasing your short-term assets because you're increasing your inventory account, okay? And now this accumulated depletion, where is this accumulated depletion account, the credit? Where is that going to appear on the balance sheet, do you think? Where is that accumulated depletion going to appear on the balance sheet? Or is it going to appear? Okay, under the asset, Daniel, excellent. This accumulated depletion, just like the accumulated depreciation, very good, is going to appear directly below the related natural resource. Okay, and it's going to decrease what the book value of that natural resource is. Excellent. Okay, it's a contra asset account, exactly like accumulated depreciation. Remember though, okay, that when we're talking about these natural resources basically are a separate section that appear under the plant, property, and equipment. Okay, because they're considered the long-term assets. It's a separate section within the plant, property, and equipment section of the balance sheet. Very good. Okay. Okay, so let's go to the next chapter. The next chapter was Appendix C. Okay, and Appendix C basically dealt with partnerships, a very different chapter. Okay, and I hope that after studying this, none of you are ever going to enter into a general partnership because you see the amount of liability that you actually take on in these situations. Okay, remember that for partnerships, the income that is basically earned by the partnership is not a separate legal entity. So all income must be allocated to the individual partners on an annual basis. Okay, remember the qualities that make a general partnership, at least, so risky is the fact that there is mutual agency, meaning that any partner can basically bind that partnership, can bind all the other partners in a particular contract. Even if the other partners were not aware that they signed a contract, any of the individual partners can bind the partnership into a legal contract. Okay, that's a mutual agency and also unlimited liability. Okay, and that basically means the unlimited liability basically holds that if the assets of the partnership, okay, are not enough to pay off any creditors, okay, those creditors can come after the personal assets of the partners. So you could lose your home, your car, any of your personal assets in order to pay off the liabilities of the partnership. Okay, those two qualities make it very high risk. Okay. Remember that income taxes, a partnership does not pay income taxes. It's the partners that have to pay the income taxes based on their allocation of income from the partnership. Okay, and remember that if partners at the beginning of the the partnership is first formed, or even after the partnership has been operating for a period of time, if a partner contributes assets to the corporation, remember the value attributed to those assets is going to be the fair market value. Okay, so any contributed assets, the fair market value of those assets. So if those assets were used previously in a sole proprietorship, It doesn't matter what the book value of those assets were in the sole proprietorship. It has to be the agreed upon fair market value at the time of contribution to the new partnership. Okay, remember there are three different types of partnerships. A general partnership, which is the most risky, okay, because it has the most liability assessed on all the partners. Then you can have a general partnership. You can have a limited partnership, where you have basically one or two managers of that corporation that have limited liability. And then you have general partners in a limited partnership, and then you have silent partners, okay, or partners that are just there to contribute money, and they have no say in the management of that partnership, so their legal liability is limited as well. Okay, so you have a general partnership, a limited partnership, which are typically for more high risk type of ventures, like a real estate development, mining, or things of that nature. And the third type of partnership is a limited liability partnership. And the limited liability partnerships are for individuals like your dentist, your doctor, architectural firms, okay, where basically if they have a contract for a limited liability partnership, each individual partner is only responsible for claims against themselves. Okay, they don't take on any liability for outside, for any of the claims against other partners. Okay, but remember, it must be expressly stated in the partnership agreement what type of partnership this actually is. And any of the creditors have to be made aware of the fact that which type of partnership actually exists. Okay, because it's going to affect the amount of their recovery in the event of a dissolution, okay, or liquidation. All right, Chapter 13. Okay, Chapter 13 dealt with, Chapter 13 dealt with the statement of cash flows. Okay, first time that we dealt with cash, a cash-only basis. Okay, so basically you had to apply all of your knowledge about accrual accounting, and you had to then reverse it, okay, in order to figure out what the cash effects of these transactions were. Remember, my favorite thing is in the statement of cash flows, you have three separate sections, or OIF, operating, investing, financing. Okay, remember that in the operating section, okay, and typically in the long term, the operating section is the most important section. That's the section you would want to see most revenues being generated, because that's the core operations of the business. What basically happens is that in the operating section, you're going to unaccrue the income statement. Okay, you're going to basically unaccrue. You start with the sales figure on the income statement, and you're going to unaccrue each of the accounts that appear there. Okay, and you're going to unaccrue them by looking at changes in the related balance sheet accounts. Okay, and there were certain formulas that we had to that you had to learn in order to do the unaccruing, especially in the operating section. Okay, so you have to remember how if we have sales, you have to figure out, okay, some of those sales are credit sales, so they don't affect cash. So you have to remember how you calculate cash from customers. Okay, cash paid to operating expenses. Okay, those formulas that came about. Okay, remember in the operating section, that's cash that's basically generated from the day-to-day operations of the business. Okay, and again, in each of these sections, you're always going to show what the sources of cash were. That is, how did cash increase in this section? And you're also going to contrast it then with the uses of cash in that particular section. Okay, and that's going to show you the net effect of cash. Okay, the second section is the investing section. Okay, and the investing section, basically you're going to show what all the sources and uses of cash are. Okay, again, for this year from the purchase and sale of assets, okay, such as marketable securities, such as of assets such as machinery, auto, etc., and also the purchase, the change of cash on the purchase and sale of marketable securities, okay, or investments. Okay, and then finally, the last thing that shows in the investing section is any change in loans that are outstanding. And these are loans that the corporation makes to outside parties. Okay, are they paying off the loans? That's going to be, if a third party is paying off their loans, that's going to be a source of cash. If a third party is taking out loans from the corporation, that's of course going to be a use of cash. Okay, and then finally the third section, which is the financing section. Again, it's going to be, you're going to look at the sources and uses of cash based on either the issue or the retirement of bonds payable. So the change in bonds payable. The issue of additional shares of stock, of course, is a source of cash, or the purchase of treasury stock, which is a use of cash, and the payment of dividends. Okay, those are the typical transactions that happen in each of those three sections. So you have to remember, you have to know the formulas and how those transactions are reflected. Remember, the statement of cash flows is a required financial statement that must be prepared. Okay, in addition to the balance sheet, the income statement, okay, they have to be, it must be prepared. Okay, and it's so important because of the fact that it shows you exactly how much cash a corporation has, okay, to pay off its liabilities and its employees, to pay off its debts. Remember, because a corporation can be profitable, okay, it can be generating net income, but if it doesn't have enough cash available, okay, it can basically go bankrupt. Okay, because it's not able to pay. You can't pay off a creditor with an asset you have, okay, other than cash. They want cash. Okay, so that's why this financial statement is so critical and different from every other financial statement that we've dealt with. Okay, the chapter after that was chapter 7. Again, we went back, and this was the uncollectible accounts receivable. Okay, and now we know that credit sales are a high source of income or revenue to most corporations, but we know that as a normal course of business, it's not unusual for some of these accounts receivable to end up being uncollectible. Okay, and what GAAP requires is that they don't let you wait. They don't let the corporation wait until they actually get the phone call from their customer saying we can't pay you. GAAP requires that the corporation basically set up an allowance account, okay, and basically estimates the amount of their bad debt expense for each period, okay, and it must be done at least once a year at year end, okay, to estimate the amount of bad debt expense based on the current year's credit sales. Okay, there's two different ways to come up with the allowance for doubtful accounts. You have the balance sheet method, okay, and remember the balance sheet method basically uses the aging of accounts receivable. Very good, Rachel. Excellent. The aging of accounts receivable, and don't forget, they have to give you this information in the problem in order to do this, right? You have to know how long these accounts receivable have been outstanding and what the related probability of them being uncollectible is. And that's going to lead you to figure out what your allowance is that you're going to establish. And then you also have your income statement method. Okay, and the income statement method basically, you're just basically going to take a percentage of credit sales. Okay, based on the percentage of credit sales, and again, you would be told what each of those are. The percentage that you believe is going to be bad debt, and the actual credit sales figure for the year, and that's going to give you the information in order to establish your allowance at year end. Okay, remember that the balance sheet method always considers what the existing balance is in the allowance account. Oh, here, I see, Rachel, balance sheet method, you need to know the previous month's balance. Yes, in the allowance for doubtful accounts. Exactly, a very good point, Rachel. Remember that under the balance sheet method, you have to always consider what the existing balance in the allowance account is. okay, before you replenish it. Because remember, the amount that you come up with as your balance sheet amount, okay, that is going to be the ending balance in your allowance account, okay? When you use the income statement method doesn't worry about what the existing balance in the allowance account is. You're just always going to credit your allowance for doubtful accounts and your debit for bad debt expense. You're just going to debit it for whatever the result of this formula is. And you don't have to worry about what the pre-existing balance in that account was. Okay, but the balance sheet method, you do have to consider it. Okay, then the third method, okay, of dealing with uncollectible account expense is the direct write-off method. Okay, GAAP does not allow the direct write-off method for financial statement purposes. Okay, GAAP requires that a corporation utilize one of the estimates. Okay, you have to basically establish an allowance account, okay, for publicly traded corporations for dealing with allowance for bad debt, for setting up for bad debt. Under the direct write-off method, okay, the direct write-off method just basically does not establish any allowance account. But whenever you get basically that dreaded phone call from your customer saying, I can't pay you for the receivable that I owe you, with the direct write-off method, that's when you're just going to debit the bad debt expense. Okay, when you get that phone call under the direct write-off method, you just debit what the related expense is, and then you're going to credit the accounts receivable. So the direct write-off method does not use an allowance account, okay, but the direct write-off method is not allowed to be used by GAAP. Okay, GAAP does not allow the direct write-off method. It requires you use one of the allowance methods. But of course, just to keep life interesting, the IRS requires that when a corporation files their tax return, the IRS only accepts the direct write-off method. They don't let the corporation establish that allowance account. Okay, so there you see where you have an accounting system, and the accounting system has to provide for this information in different ways based on how what the reporting entity, however the regulatory agency requires this information be reported. The SEC wants it one way, okay, and the IRS wants it another way, and that's totally legal. That's and again, the accounting system has to be flexible enough in order to provide the information in this format. That's why accountants always have jobs, right? So many different regulatory requirements, reporting requirements, etc. Okay. All right. The next chapter, again, now we left financial accounting and we started dealing with managerial accounting. Okay, in chapter 16, we started dealing with manufacturers, okay, the manufacturing operations. Okay, we weren't just dealing with merchandisers or retailers. Okay, these are actually the companies that are manufacturing the actual products that they're selling. Okay, remember, in a manufacturing firm, there's a distinction between product costs and period costs. Remember, the product costs are going to be direct labor, direct material, and that dreaded account manufacturing overhead. Okay, any costs that are incurred in the factory setting are considered product costs. Okay, then you also have period costs. Period costs are charged to expense in the period that they are incurred, and those period costs are going to include any general and administrative charges. Okay, any general and administrative expenses, and that includes really high expenses like the chairman's salary, right, the CEO's salary. All of those expenses are considered period costs and are charged to expense in the current time period. They are not a product cost. Remember that product costs are inventoriable. Right? Once you have an inventory, you set up an inventory account, and only when that inventory is sold, that's when it gets transferred. The cost gets transferred to the cost of goods sold. Okay. Oh, here, and here we have the product costs, the three different product costs, direct labor, direct materials, and manufacturing overhead. And remember, for a manufacturer, you have three separate inventory accounts. You have the direct materials inventory, you have the work in process inventory, and finally the finished goods inventory. And how those three inventory accounts basically interact, okay, the journal entries between them. Okay, how costs flow through those three inventory accounts. All right, then we had chapter 17, and chapter 17 basically dealt with POHR, or another way to refer to that is the predetermined overhead rate. Okay, and remember, that's the budgeted rate that is established at the end of every year, and it's going to apply to the next year. Okay, so it's established at the beginning of the year for the current year, let's say it that way. Okay, how do you figure out what the predetermined overhead rate is? Remember, a corporation never knows the amount of their actual manufacturing overhead until the year is over. Okay, but a corporation has to charge their jobs on an ongoing basis. Okay, they can't wait till the end of the year to apply manufacturing overhead to their jobs. Okay, so what do? They have to budget it, and they have to basically come up with a way to apply that manufacturing overhead to their ongoing jobs. Okay, so at the beginning of the year, they're going to make an estimate. Okay, they're going to estimate the budgeted amounts of their manufacturing overhead that they believe they're going to incur for this year. Okay, so the total dollar amount is going to be estimated, and of course it's going to rely on what last year's expenses were, okay, and then any adjustments in production or in cost that they anticipate, okay, and then they are going to divide by some type of total estimated cost driver. Okay, now in the past, some of the cost drivers that they used were direct labor hours, right, direct labor hours, units produced. Okay, what these are, units produced, these were basically the cost drivers. Okay, so the corporation believed that manufacturing overhead basically was correlated, okay, with these cost drivers, either direct labor, so the more direct labor hours incurred, the more manufacturing overhead was applied. Okay, the more units produced, the more the more units are produced. That if that was the cost driver, the more manufacturing overhead then would be applied. Okay, and that was basically historically those were effective cost drivers. Okay, but now in light of all the automation, those drivers are not as successful as they used to be. Okay, and that's why the corporations have basically turned to ABC, okay, or activity-based costing. That's what the future of job order costing is. Okay, using different cost drivers that more effectively apply manufacturing overhead to your production. Okay, so once you figure out what you take, to go back, you take your estimated budgeted manufacturing overhead for the coming year, you divide by some estimated cost driver. Okay, and that's going to give you your manufacturing overhead application rate, and then you're going to apply the manufacturing overhead based on the actual cost driver. Okay, so based on the actual direct labor hours per job, based on the actual number of units produced on a job, that's how you would apply manufacturing overhead then over the course of the year. Okay, now in chapter 17, you also learned about a job cost sheet. And the job cost sheet is basically, it serves as a subsidiary ledger. And it just tells you, okay, for each job that has been undertaken by this corporation, okay, on a job-by-job basis, how much direct labor, how much direct materials, and how much manufacturing overhead has been applied to each of these jobs. Okay, and again, it's actual direct labor, actual direct materials, and applied manufacturing overhead. Okay. And activity-based costing, this is what basically is in the future. Now that we're dealing with a global environment, again, this type of costing was undertaken by Japan in like the 1950s and 60s. Okay, that's why they have such effective production there at a much lower cost. Okay, they were actually utilizing activity-based costing much before the United States was. But now, in light of more global competition, American companies are changing the way that they manufacture and also capture the related costs based on activity-based costing. And those have, remember, activity-based costing have very different types of cost drivers, okay, which relate more accurately to the production. Okay, then Chapter 20. Chapter 20 dealt with CVP analysis. Remember, that's cost, volume, profit analysis. Okay, when we were dealing with CVP analysis, remember that we changed our income statement. Okay, so the income statement for cost, volume, profit analysis, again, here, we're going to be dividing cost based on how they actually behave. Okay, so here, with cost, volume, profit analysis, just like we did for our merchandisers' income statement. Of course, we're always going to start with revenue. So we start with sales revenue. Okay, and what gets deducted after sales revenue in a CVP income statement? Who remembers? What gets deducted first in a CVP income statement? What type of expense? Cricket, cricket. Come on, guys. In CVP analysis, what type of cost is deducted directly from sales revenue? Nope, not fixed. Variable cost, excellent, guys. Very good. Christian, Casey, Daniel, excellent. Variable costs are going to be deducted first. Okay, so we're dividing costs here based on how they behave. Okay, so here, sales revenue, we're going to subtract variable cost first. Okay, and remember, that is going to lead us to arrive at our contribution margin. And that's going to give us our contribution margin. Okay, then after we determine what our contribution margin is, what is going to be deducted next, okay, is going to be, now we're going to subtract our fixed costs. Okay, and after our fixed costs are deducted, that is going to lead us to arrive at our, remember, not net income when we're dealing with CVP analysis, but our operating income. Okay. When we set up our income statement this way, it's going to give us a lot more opportunities to figure out what, based on whatever we want our operating or targeted operating income to be, we're going to be able to look at these numbers and adjust our information very easily, okay, for any operating level that we desire. Okay, so here we're dealing with CVP analysis. One of the most important figures is this is the contribution margin. Okay, because looking at the contribution margin, or the amount of revenue remaining to cover all of your fixed cost and the operating income, that gives us a very powerful analysis tool. Okay, one of the first things that you can determine when you're in CVP analysis, when you set up your income statement this way, is the break-even point. Okay, remember the break-even point is the point where total revenues equal total costs. Okay, so you know that if you sell one more unit, the corporation knows it will generate a profit. If it sells one unit less, they know that they're going to be operating at a loss. Okay, once you know what your operating, once you know what your break-even point is, remember the formula. You could just add to that formula. You just add your targeted net income, and then you can figure out from there the number of units that you must produce, okay, or the sales dollars, okay, or sales dollars in order to arrive at whatever your targeted net income is, okay? And remember that not only accountants use CVP analysis. In the example we saw in our text that we went over in class, we saw how the manager of advertising, the VP of sales, the production manager, all of those individuals had their input into CVP analysis to determine what they wanted the production to be for the coming year. Okay, so really, really important analysis tool. And again, this is the formula for basically figuring out what you want either the units of production or your sales dollars to equal. And then economies of scale. Okay, remember when we talked about economies of scale, typically those type of companies have a very large amount of fixed costs that they have to absorb in their operations. Okay, such as airlines, car manufacturers, oil refineries. Okay, when an economy of scale exists, remember that that producer tries to basically maximize their output, because the more output they have in an economy of scale, the lower the related cost per unit is. Okay, so that's basically how you try to maximize your production and reduce the cost per unit. All right, and then our last chapter was chapter 14. I just went over a couple of ratios for you to understand. One was the current ratio, current assets divided by current liabilities, the debt ratio, okay, which is total debt divided by total assets, and also just the classified balance sheet. And the classified balance sheet, again, that just dealt with how you present the information on your financial statements. A classified balance sheet would just have a subtotal at the end of the current assets, a subtotal for the long-term assets, a subtotal for current liabilities versus long-term liabilities. And again, that's just the way the information is presented. Okay, and a corporation can decide on any format that they want. In order to, and again, it makes analysis easier, you know, for the creditors, for the accountants, whoever's investors, who's ever looking at this information. Okay, so that's my overview for the semester. Does anybody have any specific questions that they want to go over? Okay, if not, okay, can we go over one of the exam? We mean like the entire exam? Okay, if you have one question, sure, go ahead.
Hey, can you hear me?
Yes.
Hi. So the question stated, it said, salary allowances to partners when dividing net income are not expenses of the business, do not get recorded, are recorded, or are not accounted for.
Okay, and the answer there, it should be, what is it, are not expenses of the business, right?
No, it says, so that's what I put, are not expenses of the business, but it marked it wrong, and it says are not accounted for, which I was confused about and wanted to go over.
Okay, so, all right, so when basically the partner's salary to the business, you know that a partner's salary cannot be deducted. Okay, so in the books and records of the corporation on the income statement, they cannot be recorded, okay, as an expense of the business. Okay, the way that a partner's salary is basically going to be reflected is that after the net income for the business is determined, all the other revenues and expenses, and remember, if they have employees working for them, Okay, those employees' salaries are expenses of the business. Okay, but a partner's salary is not going to be recorded. Okay, how a partner is going to be basically provided for. What's going to happen is that once the net income of the partnership is determined, then they're going to allocate, once the net income for the partnership, that's when they start allocating the net income, because all net income has to be allocated to the specific partners. It's going to be considered an allocation to the individual partners. It's not going to be recorded as an expense of the business.
So then why is the answer do not get recorded? So the correct answer is not accounted for, and the answer that I put are not expenses of the business. But then now I'm also thinking about it. Why is the answer do not get recorded?
Well, they don't get recorded because you'll never see the partner's salary being recorded. You'll never see it being an expense of the business because it's not an expense of the business. It's considered an allocation of the net income after the net income of the partnership is determined. So it's not recorded at all. The expense of the salaries, the partner's salary expense. It's not recorded at all.
Okay, got it.
Okay. Anyone else? All right. If you have no other questions, again, you could email me if you have a question. But what I'll do is I'll post this. I mean, you can have access to it here as well, but I'll post it on Blackboard so you can just access it separately. Okay, and again, this is just like a guide. Okay, you still have to go over and review the details within each chapter, but this is really, and you should be proud of yourselves. You learned a lot of information over the course of this semester. Okay, and again, as I'm sure all of you know, it's going to be virtual again next semester, but hopefully in the fall, for those of you who are still going to be students, which I think would be most of you at that point, you'll be able to go back live, hopefully. Okay. Everybody good? Okay, stay healthy, stay happy, make sure be online next Tuesday for the exam. And oh, you're welcome. Good luck to all of you. Okay, stay healthy, stay happy, get your vaccines early if you can. Okay, thank you. Thank you for a good semester also, everybody. Have a good final and a good break, okay? Shamia, Casey, everybody, Joshua, Maria, Kareem, Manpreet. Good luck to you all. You're welcome. Keep working hard. Very good, Lysander.